All right. Hello, everyone. Thank you so much for joining us today. I'm here today with Bruno Bertocci. Bruno is the chair of our ESG Technical Committee at CFA Institute. And my name is Deborah Kidd. I'm a director in the Global Industry Standards team at CFA Institute. And today we're presenting our work on net zero investing, specifically solutions for benchmarks, incentives, and time horizons. So Bruno and I are thrilled to be here today with you guys. There's our bios, and I'll go through the agenda quickly before turning it over to Bruno. So we're going to start with an overview of what is net zero investing. And then we'll talk about the objectives that are specific to a net zero investment program. And we'll talk about what climate risk management is and how it differs from traditional risk management. And then we'll talk about the differences in traditional benchmarks, incentives, and time horizons versus solutions for incorporating a net zero investment program into an overall investment program, and how you would benchmark and incentivize that over specific time horizons. So with that, I will turn it over to Bruno.
Great. I want to say, first of all, that if you have a question or we aren't clear about something we're talking about, raise your hand and we'll try to address it on the spot, as opposed to leaving it to the end. Go right ahead and interrupt us, no problem. So maybe you can go to the next slide, Deborah. Great. So let's talk about what net zero investing is. And you should think of it as something that is on top of what you're already doing in a specific portfolio. So as we say at the bottom, the objective of portfolio is to achieve a certain risk and return target. And if you layer on a net zero strategy, you're trying to use your investment strategy in the portfolio, and we'll talk about engagement as well. But you're trying to use the assets in the portfolio to mitigate climate change. You're trying to reduce the growth in greenhouse gas emissions. And this can be achieved in various ways, which we will talk about. But it involves modifying what you're doing in the portfolio. It involves addressing investments in companies that can improve the climate one way or another. It includes engagement with companies to lower their emissions. But along the way, we don't want to lose sight of the fact that this is a A plus B. So you can't lower your risk return targets in a net zero strategy unless it's your own personal money. We're talking about a pension fund and fiduciary responsibility. You need to do both. So that's what net zero is really all about. It's really an attempt to energize a portfolio to help improve the world that we live in. Do you want me to do this slide, Deb?
Sure. Did I advance too soon?
It's okay. This is good.
Okay.
So no, you can go ahead.
Okay. So yes, if you wanted to give a walkthrough on the objectives, that would be great.
So the most important part about a net zero program is, as I mentioned, you need to keep your risk and return objectives in mind. And you should see your investment program is a system of interconnected parts, right? It's not just one thing. You're doing more than one thing at the same time. You're trying to find companies that can reduce greenhouse gas emissions through products and services. You're trying to engage with companies to help them lower their carbon footprint. You're reducing risk by avoiding companies that are experiencing either transition risk, meaning they can't change their business model in time, or they're subject to regulatory pressures. And so this involves a deep understanding of all the components of a portfolio. And typically net zero strategies are applied at the top pension fund level. So, you can think of it as something that involves every asset class. And so it can involve equities and bonds, it can involve private equity, infrastructure, really everything that a pension fund might be responsible for can be applicable to execute a net zero strategy. And the other part is that there are metrics and benchmarks that are outside of the normal risk return benchmarks that we're used to that can help both assess where the portfolio is positioned and where it's going. One of the things to keep in mind is a link to financial materiality. And let me explain what I mean by that. If you say, well, I'm just going to engage with companies generally to see if they can lower their carbon emissions, that's a noble goal, and there's nothing wrong with it. But really, you should think about it as I'm trying to engage with company A because if I lower their carbon emissions, they will either be less risky or more profitable or both. So there needs to be a link from the broad objective of net zero investing down to the nuts and bolts or the details of financial analysis. And sometimes this isn't precise. This requires estimation, but still, you should be thinking about, well, if this happens, is the company going to be worth more successful, or less risky? And the final aspect is a good net zero program has incentives and targets to guide progress. You can't tell whether you're succeeding with a net zero strategy unless you set yourself up with some targets and a methodology to see whether your efforts are bearing fruit. And if they are, great. And if they're not, then you have to adjust what you're doing. Next slide. There we go. Do you want to do this one, Deb?
Oops, sure. So fiduciary considerations, that definitely depends on jurisdiction. So as you know, there in the US that looks quite different than in Europe and the UK, where net zero or climate risk is considered part of fiduciary duty specifically. But there are universal core principles that apply across all jurisdictions. And one is the duty of care and the duty of prudence. So you have to, as a prudent person and taking care of the beneficiaries as part of your responsibilities, you have to consider all financially material risks. And climate risk is one of those financially material risks. And you also have the duty of loyalty. So your actions must benefit the plan participants and beneficiaries. So you have to act on behalf of them rather than focusing as much on the plan sponsor or the companies you're invested in. And it's valuable to link and document your climate action engagement to financially material targets such as valuation and cash flows. And Bruno touched on that earlier. So you want to be able to show that the actions that you're taking sit within this duty to conduct the portfolio investments with financially material objectives. Bruno, did you want to add anything to that?
Yeah, not too much, and just say, look, we understand, and everybody understands that it's not easy to say if I engage with the company exactly how much more it might be worth or how much less risky it is. But that's okay, because a lot of climate risk isn't really very easy to quantify or measure. But the idea is, well, at least write down at a minimum, I'm going to engage the company and lower its carbon footprint because I think for example, closing its coal-powered fire plants, generating plants will make the company more valuable, and you can estimate how much that might be. I think it's really a process of learning by doing. And so I think the recording, the documenting, the note taking is part of that, because this isn't an exact science. Pension plans and investors around the world are seeking a way forward with net zero strategies, but they're very novel. And the other thing to think about, and we'll touch about on this a little later, is you can't use past history to project what's going to happen in the future, because climate change is new. And many of the effects are either somewhat undefined or unknown. And so you have to project forward what you're doing into the future and do the very best you can.
That's a good segue into climate risk management. So Bruno, do you want to walk our audience through what that looks like and how it's
Sure.
different from traditional management? For,
Yeah, sure. Well, the first and maybe the most important point to make is, look, when people talk about risk management, they're really talking about mean variance risk models of one kind or another. And how do mean variance models really work? Well, they take the past historical performance of stocks and project that the way they behaved in the past will be how they behave in the future. And you're doing that by, for example, if you're trying to measure the exposure of your portfolio to a particular factor, you have a portfolio that represents that factor, and you're measuring the correlation of your portfolio to this other portfolio. So that, in a BERA framework, that's how you can tell, are you exposed to the value factor or the growth factor or whatever. Well, this doesn't work very well at all with climate risk, because if you use the historical behavior of stocks to measure something that's going to happen in the future that actually didn't happen in the past, that doesn't work at all. So you need to have more forward-looking tools to do it. And to be honest, a standard risk management framework that's built around history isn't going to help you much. And the other thing is, in the early days of net zero investing and climate risk investing, investors tended to focus on corporate carbon footprints. And I guess what I would say about that is, I'm not going to say that's not useful. It is useful, but you have to really keep in mind that carbon footprints are industry specific. A software company may have little to no carbon footprint if it's just people sitting at desks. And obviously, a power plant will have a big carbon footprint. But the real question is, like for like, how does the software company compare to others like it? And how does the electric utility compare to others like it? And so that's a better frame of comparison. And you also have to think about transition risk. And just think about what's happening with electric vehicles. There's a transition risk to traditional manufacturers of cars that use internal combustion engines. If the world transitions to EVs, they'd go out of business, right? It's kind of like being a carriage manufacturer, and in an era of transition to automobiles, you'd be out of business. And then there's physical risk, and this is also very important. You have to think about where the company's assets, customers, and production facilities are located. So, some years back, for example, floods in Thailand shut down the entire disk drive manufacturing industry in Thailand, and it caused shortages and disruption all around the world. And we're seeing that, extreme flooding, storms, and so on are posing risks to manufacturing facilities, and they're especially posing risks to insurance companies and other financial players that are involved in trying to mitigate physical risk through insurance. So you really want to think about it at the asset class level, and to use some of the new risk indicators, such as science-based emission reduction targets, You want to look to see if management is incentivized to reduce emissions. You have to look to see where is the company spending its capital? Is it spending it wisely? Is it building plants that are robust and safe from a climate risk perspective? These are all things that you can think about from a risk management perspective that are more forward-looking than a traditional risk management framework.
So two additional considerations on that is, and we'll talk about this a little more over the next few slides, but so active management is typically going to generate better returns from a net zero perspective, better net zero outcomes than passive index tracking. And again, we'll talk about that on an upcoming slide. And to remember that risk also includes upside risk, which Bruno talked about. Transitions and trend opportunities exist across both public and private markets. So now I'm going to dive into benchmarks. So as you know, market indexes are the investment industry's benchmark of choice for portfolios of listed securities. And they work very well for giving a basis for measuring manager skill against an asset class benchmark, but they don't work at all. They're not effective for measuring net zero efforts or outcome. And to address this problem, index providers have come up with decarbonizing indexes that will guide a portfolio path along a decarbonization route. The two most common are the Paris-aligned indexes and the carbon transition benchmarks. And the criteria for both of these were set by the European Union. And both of these indexes start with a reduction of 30 to 50% from the parent index, which would be a typical market class index like the ACWI. And then it would have a decarbonization pathway of reducing emissions by 7% each year. And these are designed to be tracking indexes. So you're not looking actually to measure active management skill in general against these, but to track them. And so although designed as passive indexes, these actually function more as actively managed indexes or portfolios. So they have several characteristics that look more like active management. One, traditional indexes are constructed according to rules-based criteria that's well-defined and transparent. And decarbonizing indexes have not always transparent construction criteria, and there is also leeway and judgment on the from the provider on which securities they can select and weight and how they might do that. And what happens is this introduces style and risk biases that you may not expect. To get increasingly lower emissions in a portfolio, an index might turn to higher weightings in low carbon industries like technology, healthcare, or communication. And that can impart different unexpected risks and biases. Like, for example, an overweight in tech companies can give a portfolio a growth bias. So these indexes, although they're designed to mimic the parent indexes and with a fairly low tracking error, that may change over time as it becomes harder and harder to select companies that can fit into the criteria of the decarbonizing pathway. So in the beginning, it's much easier, but as we continue in years, if the real economy continues to emit more emissions than the decarbonization rules, there's going to be a larger and larger tracking error over time. Um, a, an important consideration for net zero investors is that these indexes don't actually change carbon emissions in the real world. Right now, only a tiny percentage of companies are aligned with the Paris goals. So not holding companies in a portfolio tracking these indexes just means that other investors who are willing to take those risks hold those securities. And finally, as Bruno said, climate change risk in a portfolio is complicated. It's not just tied to emissions. So focusing solely on emissions reduction can still leave a portfolio exposed to other areas of climate risk. So overall, they're a useful way to start or launch a net zero program, but investors need to be aware of the limitations of using them. And so what some asset owners have done is that they have taken a set of metrics or performance indicators and they have put them together into a scorecard, which helps bring together their financial performance criteria and goals, plus their qualitative and quantitative KPIs for net zero, for their net zero goals. And a couple real world examples of this is the UK University's superannuation scheme, which developed what they call an investment balanced scorecard. So that is designed to measure the overall holistic success of their investment program. And that is composed of 6 components, which include investment risk and return and responsible investing. And within that responsible investing metric sit their net zero alignment goals. In another example, Nest, which is another UK pension scheme, sets 3 objectives for its asset managers as part of its net zero program, which includes climate reporting, reducing emissions, and voting and engagement on company transition plans. And Nest evaluates all of its managers on those objectives, plus a number of others that sit within each of these objectives. So we'll walk through what a sample net zero scorecard can look like on the following slides. So include your traditional market index can be one component. Emissions reduction, which is frequently a component of a net zero strategy, as Bruno said. Climate solutions, as we also talked about, and engagement effectiveness. So emissions reduction is very probably the most common metric, and they can range from simple to sophisticated metrics and backward looking versus forward looking. And it can be very difficult to choose among them. So many metrics that measure a company's existing or like recent calendar year emissions, such as absolute emissions, carbon intensity, fossil fuel reserves, those are backward looking, but they do help assess the current transition and regulatory risks. Forward looking metrics would include things like MSCI's implied temperature rise and climate value at risk. That's another MSCI model. So these attempt to project emissions and temperature changes and portfolio values in the future. As you might imagine, they carry many assumptions, which imparts a high model risk. So what are the most commonly used metrics? Well, a few years ago, the PRI had a workshop where they invited net zero asset managers to talk to them about what they're using, and they found the most commonly used were weighted average carbon intensity, economic emissions intensity, implied temperature rise, and financed emissions. And the workshop also found that managers tend to use more than one metric. But trying to manage backward and forward-looking metrics and assimilate all this information and track it can be very complex, and not all organizations are set up for that. So many organizations opt for just simple measurements, single metrics, such as portfolio carbon intensity, the percent of portfolios aligned with science-based target initiatives that Bruno talked about earlier, or the percent of companies with net zero goals. So we talked about also the importance of including climate solutions into a net zero investment program. And these can be integrated in one of two ways. They might be embedded into existing asset class mandates, where a manager with an equity mandate is also considering climate solution in equities within his portfolio, or they might be allocated to dedicated sleeves, climate solution sleeves. And they might be measured as a percentage of overall portfolio assets or as a fixed dollar amount. Like I want 10 billion or 5 in climate solutions, or I want 25, or probably 25% is a lot, maybe 5% of my assets in climate solutions. So you might be thinking that this is one of the easier things to track and measure, but there is no universal definition of a climate solution investment. So that's not necessarily as easy as you might think. Some investors use the European Union taxonomy to classify investments under climate solution, and some use climate bond standards, which are developed by the Climate Bonds Initiative, and those evaluate different activities and use set criteria to determine which ones meet a climate standard. And some examples of climate solutions include water treatment and distribution, renewable energy, carbon capture, and storage. Last scorecard component that we'll talk about is engagement. So engagement to be very effective is very resource intensive. It requires staff and technology resources. It requires time, often years, and it requires deep knowledge of a company and its industry and how the changes that you're engaging for can economically benefit the company. And that's really important. So some of the topics that are frequently engaged on are transition plans, governance, net zero or climate or emissions incentives, disclosure, transparency and information, and emissions reduction. And it's very, very hard to get to an overall level of portfolio emissions reduction or change by engaging just with individual companies, as you might imagine. Just a company that you're holding just a 1 or 2% in is not going to make a big difference on your overall portfolio. So it's important to engage for advocacy for policy changes that reduce or mandate emissions. And it's really hard to measure success. It's hard to attribute success to a specific investor. So if a company does make a change and that is something that you have been engaging for or your manager has been engaging for, it's hard to go back and say, yes, I contributed to this change. So what managers often do is they measure engagements by number of communications or number of companies engaged with. And as an example, the University of Ontario, their pension plan, they set an engagement target of engaging with at least 20 companies through collective and direct engagement. And Bruno, I know you've done a lot of work with engagement. Do you want to add here?
Yeah, I was just going to say, look, if the basic idea around engagement is to get a public company to do something that you'd like them to do. And we wrote a separate piece on engagement within our impact investment paper that's also on the CFA Institute website. But what did we learn about engagement? The first is you can't get a company to do anything unless it's economically possible and that management understands that it's beneficial to them. So if you want to engage with a company and ask them for a policy change, it's either going to improve the brand equity or the valuation or reduce their risk. It has to be something that management buys into. And management isn't going to listen to anything that investors ask them to do unless they understand the company pretty much as well as management does. So one of the reasons that Deborah said this takes a lot of staff and resources is engagement isn't about showing up once in a while to ask for something. It's really about having a deep conversation with the company about their business model and where they're allocating capital and where the company is going over time, and getting them to do something that's a win for the company and a win for the investor. So this plays out over a long period of time. It takes a lot of resources, and often the time frame for engagement is much longer than the investment time frame. As you know, some investors really only keep securities for a very short period of time. You wouldn't be able to have any engagement success over a short term trading period because often these efforts take years to achieve. So what we have seen is that the most effective engagers are actually some active investors who own very few securities. They own very large concentrated positions. They act almost as outside consultants to the company, and they have a very deep long-term strategy of getting the company to do something that'll generate a valuation improvement. But it's a very different strategy from an index replicating strategy, for example. So one of the things to keep in mind is engagement in a net zero strategy is likely to take quite a bit longer than most investment horizons.
Right. Thank you. I'm going to turn it over to you, Bruno, to walk through the incentives that asset owners should think about when setting a net zero program.
Sure. The first thing is that the traditional way that managers get measured is to see if you're beating a benchmark. And typically the review period is, a 3-year period. So typically if you've underperformed after a 3-year period, you're not likely to keep the mandate. And as we said before, climate change plays out over 5, 10, 15 years. So that's a multiple of the typical framework where we assess portfolio performance. And the other thing is, most fee structures are just a flat fee on assets. And so, that's supposed to pay for research and risk management and so on. But if you want a manager to take on engagement and to do it well, that's going to take a whole lot more people. And one of the things to think about is that, investment management is a business where you have enormous operating leverage. It doesn't take very many more people to run 10 billion than 1 billion. But engagement is a people intensive business. So you can't scale it up unless you add people, because the typical person can't engage more than 10 to 20 companies at a time. So this cost is not included in traditional pay structures that are just basis points for assets. And so we have seen some asset owners move to have either an explicit fee for engagement or to raise the overall fee to include engagement, or take on other ways to encourage and to help managers allocate resources to engagement that they wouldn't have had otherwise. So it's definitely
Think,
something that has to be thought
yeah,
about. You want me to tackle this slide?
sure.
Okay,
You touched
so
on like the paying for engagement there, the third
yeah,
bar GPIF. But I know
yeah,
you've done a lot of work in this area.
so that's the Japanese government pension plan. They actually started paying managers extra to do engagement because they realized that otherwise it wasn't going to happen. The other thing is to have bonuses or extra compensation that's tied to achieving net zero targets. We've seen that at a French um, asset manager, AXA, and also the middle bullet here, asset managers with an optimized index tracking approach. At my old job at UBS, we actually did that for Nest. They owned a colossal index portfolio that was indexed to the FTSE All Country World Index. And we embarked on a strategy to try to refashion that portfolio so that it took net zero into account. So what did we do? The first thing we did was to look at every company in the index relative to the IAEA carbon budget for that industry. And companies that had their proportional carbon footprint was smaller than the budget were upweighted, and those that were bigger got downweighted. So the idea was to overweight the companies that were outperforming from a net zero perspective. We also deleted a few companies like coal mining companies, but that's almost a detail. And we kept the entire portfolio within a tracking error of about 25 basis points to the underlying parent portfolio. And we also added on a small sleeve of companies that we identified as climate solutions. So the whole idea was to have our mandate by Nest was own tomorrow's companies today. In other words, overweight the companies that are moving to succeed from a net zero perspective. And then every year we would look to see if companies were outperforming relative to their allocated carbon budget, and we would reweight the portfolio, still keeping within the tracking error budget. This was turned out to be a pretty successful strategy because it didn't have a lot of tracking error, but it performed better than the parent benchmark that we'd started with. And the fee for doing it included engagement. They wanted us to engage with some of the largest holdings, which we did. And so, to give you a perspective, FTSE All Country World replicating mandate is probably about 5 basis points, and this one had triple that. I think we had 16 or so, which doesn't sound like a lot, but it was an enormous portfolio. So that's one way to do it. And it's not, it isn't as going to have the engagement of a highly concentrated portfolio, but given that pension funds own large index portfolios, this is a way forward.
Um, you may have touched on, I think, a lot of these, Bruno, um, but I know you have strong views on how the amount of incentive compensation has to be sufficient. And I think you talked about how it has to be tied to the net zero objective. And we're going to talk about the timelines for the incentives over the next few, the incentives and the objectives over the next few slides. Um, and then I think we've talked about how the internal incentives should reflect an organization's mission and its goals. So the net zero objectives should have incentives that support the mission and the goals. Um, so this is our last section before we offer some concluding thoughts. This is on time horizons, and we have touched on a number of these, but as you know, typically asset managers are evaluated over a 3-year period. And this 3-year evaluation period does not align well with an asset owner's long-term objectives, which are often 30 years, and in a net zero program, to get to 2050, we're looking at 25 years. Also not aligned with a market cycle, which is often stated as 3 to 5 years, but tends to be more like 7 years on average. And as Bruno said, engagement horizons take many years. It's not uncommon for the result of an engagement effort to not materialize for 5 years. So the 3 year time and net zero time horizons, you'll have a long horizon and then you'll have multiple shorter ones. So it does not align with those. So asset owners who are setting a net zero investment program, but then evaluating their managers on these 3 year time periods are really kind of undermining the long-term commitment that's necessary to achieve the goal. So how can you set better time horizons to reflect a net zero program? Well, it's important to keep in mind that climate change is not going to just happen all at once in 2050. It's happening now, and it's difficult, maybe impossible to quantify the effects and the opportunities that are materializing on an ongoing basis on a portfolio's asset values, but the transition opportunities and the detrimental effects are going on now, and they'll continue to do so. So asset owners need to set interim time horizons based on setting interim net zero targets. And they need to be mindful of the complexities that managers face when they are doing that, when they're setting those. So managers need to be measuring portfolio metrics. They need to be learning about companies and industries and engaging for those. They need to be spending time sourcing and identifying climate solutions. So what would productive interim targets look like? The Institutional Investors Group on Climate Change, or IIGCC, offers some guidance. So that's a nonprofit group of institutional investors, as you might guess, who are focused on managing to net zero. And they recommend setting targets inside of 10 years for emissions reduction and also for the amount that is invested in climate solutions. So getting up to your climate solution target. But in practice, most managers, and I think Bruno can speak to this, or most asset owners are not going to be comfortable with giving their manager a 10-year time horizon target for aspects of their portfolio. So what you often see that asset managers are doing, or asset owners are setting 5-year horizons that roll over, some beginning as early as 2030. And those align better with market cycles, better with engagement timeframes, and 5 to 15-year periods are more generous for decarbonization efforts. So Bruno, I know you have comments on that time horizon period and what asset owners are comfortable with.
Yeah, so it's a big ask to tell an asset owner to change their time horizon, because these shorter term time horizons are kind of embedded in the culture, and it's what the board and the staff is used to. That's the bad news. The good news is this: that most large asset owners have as a core portfolio some kind of very large index portfolio. In the US, they're using the MSCI All Country World. In Europe, often it's the FTSE All Country. And those core portfolios are there for the duration. They're not going to change. So what have asset owners done is to become more active, if you like, in the management of their passive portfolios. As I described to you, Nest became 20 to 30 basis points active with their passive portfolio. We've seen the New Zealand superannuation fund go through their what they called their target portfolio or their market portfolio, which was previously aligned with a broad index, and change it so that it's more decarbonized. And so, because these asset owners often pretty much keep these index portfolios in perpetuity, changing them from completely mechanical passive to what I would call a partially active decarbonization net zero objective can help align the long-term time horizon with these net zero objectives without really upsetting the asset allocation of the pension fund. This doesn't work so well with a fully active equity portfolio. Typically it has a shorter time horizon, but it does solve the problem with a huge chunk of a typical pension fund's portfolio, which is passive anyway.
All right, so we just offer a couple concluding thoughts. Um, so asset owners shouldn't lose sight of the overall objective of net zero investing, which is to contribute to the risk and return of their portfolio by avoiding investments that will be left behind by the transition or impacted by physical risks, and improving returns by finding ways to benefit from the transition. And a well-designed investment program with net zero goals can contribute to an asset manager's fiduciary duty by managing assets for the highest returns within the defined risk parameters for the benefit of plan participants and beneficiaries. With that, I am going to stop sharing and we can move to questions.
Thank you, Deborah. Thank you, Bruno, for the insight on the carbon investment and climate investment. While we are waiting for questions, if there will be any from our audience, yeah, Kostya, please go ahead.
Hello, can you hear me?
Yes, we can.
Yes.
Thank you, Bruno. Thank you, Deborah, about your insightful presentation. I just wanted to raise a couple of questions regarding
Sure.
what's going to happen with the net zero approach, and but it was effective for the beneficiaries of the funds which would pursue that aggressively. Like, for example, if you take oil and gas majors in Europe and the US, Chevron and Exxon were really like aggressive about we're oil and gas companies. If you don't like it, just diversify away from us. And the European like BP and Total and Shell were very sort of green friendly and maybe haven't been able to provide the value for the shareholders comparable to the American competitors. And so it's like this ultimate discussion of whether you should diversify at the level of portfolio or you should try to engage with the management and the board and maybe to the detriment of the providing the value to the shareholders. Another question is a lot of bureaucracy in this net zero approach. So 2050 is an arbitrary date. It's just, anniversary of something. And I mean, for example, nuclear, it was a no-go zone just 5 years ago. And now it's like Japanese are starting the nuclear generation. And the government really sort of trying to blame Merkel for being too greenwashy. about this whole stuff. And I mean, and again, like BlackRock, for example, being a minority shareholder, not majority shareholder, for them to be able to qualify for the net zero investment friendly or like acceptable. So a lot of bureaucracy and arbitrary things which are moving and shifting and are easily to be engineered around, either through financial engineering or like legal shenanigans. So this the question, like whether you should really engage with the companies or just disinvest from them. And another one is how would you define net zero in this on this long term when it's regulatory framework and understanding what is net zero is shifting all the time. Thank you.
Well, maybe I'll tackle the oil company question first. And that is, well, first of all, I think you made some really good points. And the first is, well, if you're a net zero investor, I think you're basically asking, should I just take those companies out of my portfolio? And the answer is, well, it depends. The first is, the one way to answer that is, well, how much tracking error do you want in your portfolio? Because if you say I'm limiting the tracking error of in my portfolio to 20 or 30 basis points, and it's hard to take them out completely, you could reduce them or change which companies you own. The underlying question is, well, what's the oil company business model in the long run? And the fact is that today, finding costs are higher than the price of oil. So it's unprofitable, pretty much, to go out and find more oil. So you can think of an oil company as being effectively a big bathtub full of oil and gas that they found years ago, and they're slowly emptying it out and selling it. And then the question is, well, what are they supposed to be doing with the cash flow? Should they be returning it to shareholders? Should they be investing in solar panels or whatever? I would say, this is a very broad statement, that oil companies haven't been very good at finding other things to do other than oil and gas. I mean, ExxonMobil tried to make typewriters at one point, you may recall. They weren't very good at it. And they did some other crazy things. So you could argue they should be run a little bit like a utility and just effectively wind down, go out of business, and return cash flow to shareholders. I think that's a valid view. There are board members now, for instance, at ExxonMobil, like Jeff Ubbins, who are working to modify their business model so that it's cleaner and to diversify into other things that they actually know how to do, like carbon capture. But your question is a good one, and I don't know that there's a single answer to it. It's down to every investor to make up their own mind. I can say, almost without exception, the biggest pension funds in the world haven't divested their oil and gas assets. And in fact, one of the biggest pension funds in the world is the Norwegian pension fund. As you know, it's funded by the Norwegian state oil and gas business. And the fund exists with the understanding that eventually the Stat Oil will go out of business or transition to doing what they're trying to do now, which is installing wind turbines, and that the state pension fund is really a cushion for the economy for when that happens. But I don't think there's a single answer to your question. It's up to every investor to make up their own mind, but it really boils down to their perception of the value of the oil and gas company business model. Without question, we're not going to turn off oil and gas tomorrow, but we're trying hard to do it, by electrifying vehicles and shifting to other cleaner forms of electrical production.
And I
Right,
know you had a
thank you.
question
And
about
then
the.
just a bit follow up. So
Mhm.
it's fine for the Equinor to be very sort of green oriented because their energy, I guess they get 95% of their energy from the hydro in
That's right.
so they don't really have like skin in the game.
Well, they do and they don't. So it's the most
I mean politically,
politically well.
because
So
they could sell the idea that we're green
yeah,
nation
yeah.
funded
I
by
know what
the
you're saying.
so,
Yeah.
yeah.
So locally, they're a
What
super
about
clean
the
economy.
US with the gallon uh, of gas being like a political statement in itself?
Yeah, well, they're not going to shut down their state oil and gas company, that's for sure, because it's funding the state oil pension fund. But they're trying to turn Stat Oil into a wind turbine company with some success, I would say. But they're a long way towards a full transition. But your point is interesting, which is, Norway, yeah, is powered by hydro, super clean, highest percentage of EVs in the world.
Thank you, Bruno. Deborah, you were up just to follow up about another question, I guess.
Sure.
So what should asset managers do with the net asset value of the portfolio? Should they reflect the climate risk somehow, and how?
You want me to try that one?
Yes,
Sure. Okay.
go for it.
So here's the thing. Forecasting the future value of a security. Let's talk about equities because that's the toughest, right? You got to make estimates of the future cash flow. You need a discount rate. You got to bring that back to the present, compare that to the stock price. That's the classic way to do it. I guess I would say, in my experience, at least, there are already so many estimation variables involved. You've got to estimate the cash flow. You've got to estimate the risk premia. You've got to decide, how long the cash flow, what kind of time horizon to use. Is the cash flow going to decline? I would say I don't think I would start altering corporate level cash flows directly in a valuation model. It certainly, where I worked before, we did not. We felt that estimating the cash flows was hard enough without introducing this X factor. What we did is we thought about it more in portfolio risk terms. We would look at our exposure to industries and to specific companies and say, do we want to limit our exposure, up our exposure to certain industries? And in an asset allocation department, they thought about asset classes. So it was better done on top of it as opposed to fooling with the cash flows themselves. I guess my analogy is, you probably wouldn't want to fool with the risk premium or the discount factor you're using in a valuation model very often, because then your past estimates wouldn't compare with your future estimates, and you wouldn't change them much because interest rates change all the time. And you could say that the risk premium that investors are using implicitly doesn't really change all that often. So think about certain parts of it as being relatively static to help you compare past with future, and then to lay on some superstructure on top of it. I think that's more helpful than fooling with the cash flows. But, you start fooling with some corporate cash flows and not others, pretty soon you have no idea where you started and where you ended up.
Thank you, Bruno. Are there any questions from the audience? If no, I will ask another one.
Sure.
So, at what point does a company carbon footprint become a material risk?
Yeah. So the question behind that really is, well, it depends, because carbon footprints are really related to the business model that you're looking at. So a cement company versus a software company, right? Or a steel company versus a food company. one is going to have a vastly bigger carbon footprint. So I don't think it's about, just the absolute size. It's more relative to the industry and relative to expectations and relative to the transition risk of the business model. One kind of interesting wrinkle that hasn't been talked about too much is, Europe is introducing this carbon border adjustment tax. And that's controversial, but it looks like it's going to happen. And so let's say you're in a heavy industry in Europe. So you're making stainless steel in Sweden, but you have a very low energy intensive production process relative to, say, an Indian steel company. You're going to get a carbon credit for that. And the Indian company that attempts to import steel into Europe is going to pay a carbon tax. So you effectively you might have slightly higher production costs, but they're offset by carbon credits. And Europe is going to start charging companies for embedded carbon budget. So if you're manufacturing cars and you have to buy steel, you're going to favor buying steel from a low carbon footprint steel company, even if it's more expensive, because you're going to pay a lower tax. And I don't. This hasn't been talked about much, but I can tell you that in some industries, the carbon credits are actually going to be quite meaningful for cash flow. And analysts and investors should start taking them into account because they're going to make a difference.
Thank you, Bruno. Now I will ask one more question, and this one will be related to fossil fuel and Ukraine situation. So Ukraine has had to rely on emergency fossil fuel solution for energy security. How do you recommend investor balance short-term energy security realities in Ukraine with long-term net zero alignment requirements?
I hardly know what to say about that. You got to do what you got to do.
Yeah.
I would say survival and defeat of Russia is paramount to the existence
Yeah.
of the Ukraine. And I wouldn't spend a second worrying about the carbon footprint at this stage. I'd worry about that sometime in the future when Ukraine is being reconstructed, but it's not something to worry about now.
Thank you. I'm just checking again, is there any question from the audience? I guess it's a no. So if not, I will close the webinar. So thank you, Bruno and Deborah, today for being with us and opening up some insights on carbon and climate investments. So we understand that net zero investing is a complex challenge, but it's also an enormous opportunity to reshape how capital supports to be flown in the future. And I like your quote about not rely on the history, but look for the future as well as own tomorrow's company today. So thank you so much, and hope to see you on our next webinars. Thank you.
Great.
Yeah, we're happy. We're happy to come back.
Anytime, and if you have any questions or anything we can do for you, please reach out. We'll do anything we can to help you out.
Yes.
Yeah.
Thank you very much for having us.
Thank you.